This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 491 was produced on July 31st, 2025. I'm Eric Townsend. Legendary natural resources speculator Rick Rule returns as this week's feature interview guest. I thought Rick was going to tell me that uranium was the hottest story going on in commodity markets, but Rick surprised me by saying he thinks oil is actually even more ripe for a rally than uranium. So we'll discuss oil, uranium, gold and silver, and much more in this week's feature interview. I'll also be hosting a live debate for Zero Hedge on the formative nuclear renaissance and where it's headed. That's at 7 p.m. Eastern on Thursday evening, July 31st. That's the same day this podcast will drop. We couldn't include the link in your research roundup because it hadn't been published yet. So just go to zerohedge.com just before 7 p.m. Thursday evening, or you can go back there later to find the replay link.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, July 30th, 2025. The S&P 500 index up 6 basis points, trading at 63.63. This number is not reflecting the bullish reactions to Microsoft and Meta earnings this morning. We'll take a closer look at that chart and the key technical levels to watch in the postgame segment. The U.S. dollar index up 276 basis points, trading at 99.89. This is the first close above the 50-day moving average in 150 days, begging the question as to if a short squeeze is underway. The September WTI crude oil contract up 728 basis points, trading at 70 even. This has broken out of its 1-month trade range to the upside. The September RBOB gasoline up 478 basis points, trading at 219. The December gold contract down 132 basis points, trading at 33.53. The bullish breakout attempt failed at previous highs, and now gold finds itself at June lows at the risk of breaking key support. The September copper contract down 2,457 basis points to 439. The tariff-driven volatility continues. Uranium down 180 basis points to 71.10. The U.S. 10-year Treasury yield down 4 basis points, trading at 436. And the key news to watch this week is Friday's jobs numbers and the ISM manufacturing PMIs. Next week, we have the ISM services PMIs. This week's feature interview guest is Rick Rule. Eric and Rick discuss the opportunities in oil, the long-term outlook on uranium, gold, silver, policy risks, and market dynamics. Eric's interview with Rick Rule is coming up as MacroVoices continues right here at MacroVoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Rule Investment Media founder Rick Rule. Rick, it's great to get you back. It's been years since we've had you on MacroVoices. I was fascinated because I thought you were going to tell me, hey, obviously in the natural resources space that you focus on, uranium's got to be the hot story. Let's talk about that first. Now, I'm an oil trader, have been former member of the exchange, everything else. You actually told me off the air, you think even more compelling than the uranium story, which we both agree is incredibly compelling, is the oil story. I'm an oil trader who didn't know that. Fill me in.
Well, Eric, as you know, I've been associated with both oil and uranium for a very long time. And uranium has been extremely good to me. And I think the structure of the uranium market is changing in ways that we'll talk about later. For most investors, however, most investors are better off probably seeking beta than alpha, defining beta tightly as the outperformance of one sector relative to the broad market. The oil and gas business is a big business. It's a good business. It has some very good business people in it. So for people who aren't professional investors, I suspect that they're better off in the oil business than they are the uranium business. For people who are professional, for people who are willing to do the risks, who are willing to take the risk, do the work, and certainly endure the volatility, I suspect that the outcome is all about uranium. An easy way to say it would be oil's beta, or oil and gas is beta, and uranium is alpha.
Okay, well, let's just take the counter argument. Some people would say, wait a minute, even before you worry about the beta, you've got a huge amount of policy risk because President Trump seems to want lower oil prices, but he also has policies that seem to bring about higher oil prices. He's not a real easy guy to read. It seems like there's a lot of uncertainty there.
I think in the next 6 months, that's true. It might come as a surprise to Mr. Trump that the market is bigger than he is. The International Energy Agency would suggest that the oil industry as a whole, including parastatal firms, is now underinvesting in sustaining capital, never mind new project capital, but sustaining capital, to the extent of about $2 billion a day. That has impacts in the out years, in things like years 2, 3, and 4. One could argue that as a consequence of higher capital costs, both higher debt costs and lower oil equity prices, in other words, a higher cost of capital, that you have seen at least a temporary plateau in U.S. production, unconventional U.S. production. Certainly, we can bring more oil on in the U.S. if the prices go up, or we can bring more oil on if either the credit market, particularly the non-investment grade credit market, eases, or if the price of oil equities rise. But the circumstance that we have now with low oil equity prices, high debt capital costs, particularly non-investment grade debt capital costs for the domestic oil industry, and oil prices that are hovering dangerously close to the total cost of production. And if you combine that with greatly reduced capital expenditures by parastatal oil companies, particularly Pemex and PDVSA, I think you're due for a surprise in the oil markets in 2 or 3 years. I also think that financial markets are echoing your suggestion that there are political headwinds around oil. The big thinkers of the world, our former president, Biden, my favorite energy physicist, Greta Thunberg, people like that will tell you that peak oil demand will occur in 2030 or 2032. What that means is that when people do a discounted net present value analysis on an oil company, there's no tail, despite the fact that they might have a 30-year reserve life. The truth is, if I'm right and peak oil demand occurs in 2065 or 2070, there's a very fat tail that's not priced into the market at all. So for most investors, if I had to choose one or the other, I would choose oil. For somebody like you, Eric, who's already, a sort of a rodeo veteran of financial markets and willing to do the work, willing to accept the volatility, or in fact, willing to use the volatility, then uranium's a very different story. We can talk about that later in the interview.
I want to come back to uranium for sure, but before we leave oil, something that I've noticed with great interest, and frankly, I can't explain it, is the term structure and the flat price just don't agree anymore. At least they don't relate to one another the way they used to. What we're seeing in this move, and we got that test of $55 WTI, what was it, a couple months ago? We never got anything close to contango in the market. We still had deep structural backwardation, even down at those prices. What do you make of that? It seems to suggest that something has changed about the connection between the physical and paper markets.
I think that might be true. And to be honest with you, I'm not smart enough to explain it. Part of it, I think, has to do with the fact that there may be greater economic weakness or fear of economic weakness than we know. They call copper Dr. Copper as a consequence of its alleged ability to predict economic conditions. Oil's pretty cheap. Natural gas is cheaper. It doesn't store well. And it may be a better predictor of near-term uncertainty. I think the longer-term backwardation may have to do with the fact that people mistakenly, I think, believe that other sources of energy will substitute for fossil fuels in the short term, which I don't believe to be true. But my mind is very open on the topic.
Let's talk more about oil depletion specifically, because the way I see this lining up, I don't know for sure what's going to happen, but I do know lots of smart people have told me that the only thing that really saved the world from the energy crisis we might have had back in the earlier 2000s is the U.S. shale miracle. You know, this fantastic explosion of production in the U.S. made up for declining production rates around the rest of the world. What it says to me is when the U.S. shale plays have played out, when the Western U.S. is just drilled up like Swiss cheese, and we get to the point where it's not economic at current prices or anything close to current prices to make more shale oil, then I think there's an easy answer. It's uranium. Just takes 20 or 30 years to make that transition that nobody planned ahead for. And I think we're screwed. Am I missing something?
Well, no, I don't think you are missing something. Depletion really is a function of price, technology, and the cost of capital. At $60 oil, I think it's fair to say that the United States has probably drilled up 85% of its grade A drilling locations, assuming that technology doesn't improve. There's a lot of hydrocarbon left in place in those shales. And if technology improves so that we can extract more of the resource in place, then we forestall the production plateau that you're talking about. If the cost of capital to the oil industry goes down, then we forestall it. If the price goes up, then we forestall it. But it's sort of a trifecta, Eric. We have to have one or all of the above occurring. And at present, nothing seems to be giving. It's worthy to note that the United States and Canada are both well endowed with shale reserves. And both the United States and Canada have relatively attractive regulatory regimes and great infrastructure. There are other shale horizons in the world that, if the right regulatory environment occurred, or if the right energy infrastructure was in place, or the right fiscal structure was in place, could make meaningful contributions to the world's supply of oil and gas. But who knows when that regulatory reform will take place? Who knows when the work required to put those shales into production, when or if that'll take place? Right now, the world's swing producer is the United States and to a lesser extent Canada. And if we don't have a break from technology, from capital costs, or from price, I think it's fair to say that at least U.S. production has plateaued. There's a lot of room to increase production in Canada, but for the last 10 years, the Canadian leadership, political leadership, the federal leadership, has been anti-oil and gas. And that's a really, really, truly ugly headwind. The United States, at least since the election of President Trump, has not faced that same challenge.
Now, let's imagine that we use up the rest of the spare capacity that still exists in the U.S. shale patch. So we can't expand in the U.S. We either use up Canada's capacity or Canada doesn't want to play ball politically. One way or another, you got to look for more. And it's not like the world's out of oil at that point. You can very easily go to deep water offshore, and you can go to polar exploration in order to solve that problem. What amount of dollars per barrel are we talking about in a premium if you got to go under the North Pole instead of just out in the Gulf of Mexico to get your oil?
I need to add that there's substantial shale capacity in Saudi Arabia that hasn't been exploited. They've just exploited their conventional capacity. And there's substantial shale capacity in Argentina, in Venezuela, and in particular in Russia. So there's a lot of room for shale.
Okay, let me restate the question then. I was assuming too much. Once we've played out the Western U.S. shale play and we got to find more oil, where do we go and how big of an increment in cost of production do we get as a result of having used up what we already know, have to move on to another new trick?
I don't know the answer to that, but it wouldn't surprise me if that answer had a three handle on it.
A big number.
Plus, the beauty that the shale production has is it's extremely predictable. You can model returns on capital employed fairly well. And despite the fact that, as an example, during the Biden years, you had a hostile federal administration with regards to shale, at least you had consistency and regulation in the rule of law. If you add back exploration risk, which the industry hasn't had to deal with, at least onshore, for a very long time, the uncertainty of outcome and the capital cost associated with, as an example, moving deep water conventional crude or Arctic crude to market, you're talking about uncertain outcomes with regards to time and return on capital employed. And I suspect if you combine that with what I see as the continued deterioration in the purchasing power of the US dollar, you're talking about an incentive price that is at or above $100.
Well, Rick, we couldn't agree more on where this is headed, and that takes us on to our next topic, which is uranium. Let's talk about that. We've got clearly, from a policy standpoint, a very clear message from the White House, from Secretary Wright. The nuclear renaissance is on, and it's on in earnest. Okay, great. But the lead times in the nuclear business are extremely long. And as you know, commodity markets have to balance right now, right in the here and now. They're not forward-looking like equity markets. So I want to believe that all we're seeing so far is just a little bit of excitement. We haven't even gotten, I think, to the big event yet in the uranium market. But other people might say, hey, it's doubled in the last few months. Maybe it's time to short it. I think we're just getting started. Where are we in this story? How long of a story is it?
I think it's a very long story, Eric. I don't mind saying in the very near term, like weeks, that it may be overbought. My former employer, Sprott, raised $200 million in the Physical Uranium Trust, and there's been a big buyer, Sprott, in the market. When that money runs out, remember this is a very thin market, it wouldn't surprise me to see the market soften up. But that doesn't reflect the real market. The real market is in structural deficit. And it's important to remember that Sprott itself now has bought over 60 million pounds of uranium in the Sprott Physical Uranium Trust. And that supply has gone to supply heaven, something that I don't think markets have noticed. Looking longer term, the point you make is exactly correct. The lead times involved in putting a uranium project in production are measured in decades, not in months. Even in the United States, where you have a change in the federal regulatory attitude, remember that you still need to appease state and local interests. Mercifully for the United States, most of our recoverable uranium exists in Texas and Wyoming. And at the state level, both of those jurisdictions seem to be favorable for uranium development. But as you say, these things take a very, very, very long time. While all of this is playing out, we're using substantially more uranium than we're producing. And in other parts of the world, they're building nuclear power plants like mad. What's happening domestically is interesting too, which is to say plants that were scheduled for shutdown, plants where the decline in consumption was modeled into everybody's supply and demand forecasts, are being extended. These aren't plants that need to be built. These are plants that were scheduled for shutdown that aren't going to get shut down. This is actually demand that in effect has come from nowhere. Biggest swing, of course, has been the pace of Japanese restarts. You'll recall that post-Fukushima, the second biggest uranium consumer in the world went away. 40 million pounds of annual uranium consumption went away. The political winds in Japan have changed, and both the people and the government are pro-uranium. Thus far, they have reopened 14 of 40 plants, but their intention is to reopen the balance of their shut-down plants. That's the most important near-term demand consideration because the lead times that you mentioned don't apply really to restarting what's called a hot shot or properly maintained plant. Very important to know. The second thing about uranium, Eric, that's much more fascinating to me is that the structure of the market is changing entirely. In every commodity market, as you well know as a trader, there's no price certainty in the future. The price is the bid from day to day to day. Something very different is happening in the uranium business because of the extraordinary capital cost of building these nuclear power plants. A term market in uranium is developing where producers and consumers agree to prices and volume within a reference of 5 years or 10 years or 15 years or 20 years. What that means is that uranium producers can have a contract with a credit-grade counterparty, Southern Company, Duke Power, Tokyo Electric Power, China General Nuclear, that guarantees them both price and volume for a long period of time. Unlike the oil business, as an example, where there's no price certainty, or at least very little price certainty outside the futures markets, in the uranium market, increasingly the spot market is a reference point, and prices will be set and are being set in the term market. What that means is that there is revenue certainty for uranium producers, which lowers their cost of debt capital. And I would suspect, given the earnings visibility in the out years and the certainty with which lazy securities analysts like Rick Rule can forecast cash flows, that it should lower their equity cost of capital as well. This is an extremely, extremely important circumstance that virtually nobody's paying attention to.
Rick, I've never understood this market, even going a step back from what you were talking about, which is, certainty of revenue and so forth. Let's just talk about the structure of the market. Who's selling what to who? Now, if I drive an automobile, nobody expects me to go buy my own crude oil and then hire somebody to refine it and hire somebody else to deliver it. I just go to a filling station. There's an industry that exists to sell me fuel. Why do utilities buy any natural uranium U3O8 at all? Why don't we just have an industry where all the utilities say, this is my reactor specifications, sell me EUP, finished reactor fuel, and companies that are in the oil business, the guys that are in the oil business are in the oil business, the people that consume the oil are in the construction business or whatever business they're in. They don't try to be in the oil business. Why do these utilities try to be in the uranium business? I don't get it.
Often the fuel processors, particularly the Russian fuel processors, have been undercapitalized. And one response to that has been that the utility will buy the raw material and pay the Russians a fee to process it. Remember that over 50% of the enrichment capacity and the original fuel rod fabrication capacity in the world was Russian. And the Russian fabrication industry was historically undercapitalized. That's the primary reason, I think, that you see nuclear utilities in the raw fuel business. Much more commonly now, the utilities are going to refer their purchase orders to traders or to fabricators or to integrated companies like Cameco/Westinghouse, which plans to be all things to all people. The the odd market that you described, I guess you described it correctly as an odd market. The user of the fuel was in many senses forced to finance the refiner.
Yeah, it seems to me we just have a very, very broken market where people like Grant Isaac, who's the CFO at Cameco, who's clearly on top of this, agrees with the view that I've heard from quite a few people in the uranium business, which is we got a major problem, which is the real market is the term market. The spot market is not the real market, but the spot market is the only market that is visible. There is no public term market. The data for the term market is private, and it only gets published once a month. And I hear Grant complain about that and describe the problem very accurately. But at the same time, I can't help but wonder, Grant, aren't you in a position to solve that problem yourself?
Even Grant himself believes that Cameco's term contracts are proprietary. He's a very, very bright guy, by the way, as I'm sure you've come to learn. But he believes that given that Cameco is the most important uranium producer in the world, if not the biggest, that his own intentions with regards to the uranium market are proprietary information. I believe, Eric, over 5 years, note that I said over 5 years, that uranium producers who are less opaque with their term contracts will enjoy a lower cost of capital, because I believe furnishing that information to the market will generate greater certainty with regards to future profitability and will lead to higher share prices and lower cost of capital. But we haven't come there yet. This has always been a highly, highly secretive industry. And those of us, as an example, who follow Cameco are often forced to look at the trailing quarter in terms of pounds produced, average selling price per pound, juxtapose that with the spot market, and try to figure out the status of Cameco's term book. It would be a lot more efficient if, as you suggest, they become more forthcoming. I think over the next 5 years, they will become more forthcoming because I think that capital markets will reward those producers who are forthcoming and penalize those who don't. Just for fun, let's look at a non-investment grade, small non-investment grade producer who requires, let's say, $500 million or $600 million to put a mine in production, and currently has a $250 million market cap. That's an interesting challenge. If they were producing any commodity except for uranium, it might be an insurmountable challenge, given that a lender who would be asked to put up 60 or 70% of the capital would have no sense what the selling price of the commodity that was going to be produced was going to be and what the payback term of the loan was going to be. That same junior, if they, as an example, got a fixed price contract to build the mine from Westinghouse and then pre-sold 60 or 70% of the production over 10 or 12 years to an investment grade counterparty, could take those contracts to the bank, and the bank would be much more certain because the producer had already fixed the price of building the plant and had already fixed the price for which they sold the material. Yes, it would take some of the optionality out of the shares, but it would take away almost all of the uncertainty, almost all of the downside. That's why I say that the big shock for capital markets will be continued lower cost of capital for the uranium industry than the uranium industry has experienced for many, many years.
Rick, I want to pass a prediction by you that I'd really love your feedback on. I think we're headed toward a meeting of minds here between the tech industry and the nuclear industry, where basically the AI data center guys recognize, as they already have, we got lots of money. We need lots of energy. The world doesn't have lots of energy. We better start spending our money now before the world figures out how tight the energy is so we can lock up as much of it as we possibly can for ourselves. And I think the things we've already seen very clearly evidence that, where you've had tech companies with data center interests literally paying more than current market rates to lock up the next 20 years in order to get a nuclear plant restarted. They've already done the deals on all the nuclear plants that can be restarted. So, that capacity is going to be taken up. I predict that we're headed toward a societal conflict where everybody gets pissed off and says, hey, wait a minute, when we weren't looking, big tech bought up all the energy capacity. We're pissed off about it. And, let's go have a riot over that. It's been too long since George Floyd. Let's make up the next issue to throw a riot about. I think it could be an energy crisis where people are pissed off that the capacity got bought out by high tech, and it puts nuclear energy in big contention. Do you think that's realistic? And if so, what does it mean?
I hadn't thought about it, to be honest, but it makes absolute sense to me. Big tech was relatively early to the party because they had the technological sophistication to understand how nuclear power worked. And I think, at least among the younger people in Silicon Valley, they had a real fear about carbon generation. And so they were inclined to nuclear before the broad population was. I hadn't thought, frankly, about the societal impact of the fact that big tech is effectively locking up all of the cheap non-carbon generating baseload power available in the country. But now that you mention it,
not just the country.
Okay, fair enough. Fair enough. I think what you're talking about is precisely the reason that Cameco bought Westinghouse. I think that they see the need for newer types of reactor fabrication and newer types of, fuel enrichment. And I believe that, as you suggest, any spare capacity that this country is going to need. And by the way, electrical demand in the United States is apparently going to double by 2050. That tells you that big tech was prescient. And I hadn't thought about the fact that people would be envious over the fact that big tech was prescient, but it makes absolute sense given the voters' track record over time.
I'll make another prediction. Big tech ain't stupid, and I think unlike other people that have looked at light water reactors and the other options that have been available for more than half of a century, big tech is more likely than other users to say, wait a minute, the design of these Westinghouse reactors is retarded. This is not the right way to build a reactor. We've known since 1958 that water was a stupid coolant for nuclear reactors. We ought to start using the ones that we've known since then are better ones. I think it's potentially a really big positive for the Generation 4 reactor companies and a negative for the Generation 3s. Maybe that's wishful thinking on my part. So I was just curious if you had a reaction.
I think it might be 10-year forward thinking. I remember participating in a discussion, myself making the mistake, talking about the potential proliferation of small modular reactors, and I talked about it as a commercially unproven technology. And one of the technology people on the panel said, Rick, have you ever heard of the U.S. Navy? They've been employing SMRs on submarines for a very long time. There's nothing about this technology that's particularly unproven. And the circumstance that you talk about, which is to say the re-engineering of a nuclear power plant, I think is absolutely positively inevitable. There is an awful lot of inertia built in to existing technologies. There's something like $250 billion of construction underway or permitted and financed that involve around existing technologies. Looking out 10 years, looking at what the world needs and looking at the fact that the money is all of a sudden available to nuclear power, where it's been denied to nuclear power since 1982, you can virtually count on the industry being able to take advantage of all of the technological advances that have happened since 3 Mile Island. One of the reasons I would suggest for the technical backwardness of the nuclear power industry is because it literally has been deprived of favor and capital since 3 Mile Island, and that's coming to a screeching halt. I look at the political reality in the United States, where 5 or 6 years ago, as a uranium speculator, I was vilified. Now in the Inflation Reduction Act, they want to subsidize me instead. This is sort of a sea change in attitude, and I think it brings about the type of technological evolution that you're describing.
I definitely think that we're headed towards some interesting times, and I'm hopeful that the big tech guys are going to help the nuclear industry get its act together, because we need to change the way that we build nuclear energy. That's for sure. I know, though, that I am under personal serious risk, running out of time on this interview, Rick, and if I don't talk to you about precious metals, my listeners will absolutely lynch me. So let's move on to gold and silver and what's going on there, particularly the ratio between gold and silver. How's the market? And as much as I feel, and I'm going to go out on a limb here and say I know you're going to agree with me that the fundamentals are really strong. Wait a minute. The price of gold has doubled in the last few years. The last big cycle we went through, it was about a doubling from just below 1,000 to 1,900, on a measured move basis. We kind of already got it. So are we late in this cycle or are we early in this cycle?
Well, I don't know if you remember the last time we talked, Eric, but I remember saying that when people ask me when gold's going to move, I say the year 2000. It's had a pretty good move over 25 years, 9% compounded.
And better than the S&P 500 for the full 21st century, I think.
The more recent move has been more dramatic. And I think for traders, if you are somebody who bought gold the last time you and I talked, simply because it was hated or because people were bored with it, if that was your motivation, you might consider being a seller. It's not hated anymore. It's not loved, but it's not hated. In my experience, and given my own read of history, I would suggest to your listeners that gold does well during periods of time when investors and savers are concerned about the maintenance of their purchasing power in fiat currency denominated savings products. And I would suggest that those fears today are very real. A lot is made of this, but the math around the US dollar is flat lousy. I mean in an absolute sense, not in a relative sense. I think the US dollar likely does relatively well against other currencies. But in an absolute sense, for US dollar savers, the math is horrible. The on-balance sheet liabilities of the U.S. government are $37 trillion, or about $30 trillion net of the Fed's balance sheet. Now, to put that in perspective, in 1982, our national debt was about 32% of GDP. Now it's something like 120% of GDP. But more concerning to me, Eric, is that the off-balance sheet liabilities of the U.S. government, the net present value of unfunded entitlement liabilities, Medicare, Medicaid, Social Security, federal pensions, military pensions, that number, according to the Congressional Budget Office, exceeds $100 trillion. To put that number in reference, the gross federal revenue is $5 trillion. So think about on-balance sheet and off-balance sheet liabilities of the U.S. government exceeding $130 trillion with a gross federal budget of $5 trillion. Now factor in the growth in the on-balance sheet deficit of $2 trillion a year and the Congressional Budget Office forecast of the growth in off-balance sheet liabilities of another $2 trillion a year. These are bad numbers. The on and off balance sheet deficit increases by $4 trillion a year against a gross federal budget of $5 trillion a year. I don't want to be alarmist, Eric, but it sort of reminds me of the Hemingway quote about how we went broke. He said slowly at first and then all of a sudden. I think that we need to come to grips with this. I don't think that Congress or the voters is in the mood to stop spending. And I don't think that we're going to have an honest default. I don't think that the voters are going to say to an old guy like me, yeah, right, you paid into Social Security for 60 years. Too bad, so sad, no money, strong letter to follow. I think we have a dishonest default. And there's precedent for this. In the decade of the 1970s, according to the Office of Management and Budget, the spending power of the U.S. dollar declined by 75% in 10 years. Not coincidentally, the gold price went up 30-fold. I don't think that the gold price goes up 30-fold from here, but I suspect that the only way that we service or pretend to service our debt is by inflating away the net present value of the liability, by reducing the spending power of the U.S. dollar while not fully indexing taxes to inflation. My suspicion is that if I am correct, that if we deal with $130 trillion in debt by devaluing the obligation, that the purchasing power of the U.S. dollar, again in real terms, declines fourfold. And it wouldn't surprise me to see the increase in the gold price approximately reflect the deterioration of the purchasing power of the U.S. dollar. If you believe like that, it's very difficult not to see strong gold prices, likely stronger silver prices, and likely very strong gold equities prices. I'm not talking about the 3-month time frame or the 6-month time frame, but I'm certainly of the belief that over a decade, the U.S. dollar loses 75% of its purchasing power.
Let's talk a little bit more about gold versus gold and silver mining equities. Because, boy, Rick, a lot of people are saying gold-silver ratio is out of whack. You're much better off buying silver here. But hang on. It feels to me like a lot of this is really being driven by central bank purchases. They're buying gold, not silver. So I could make an argument for if that's the cause, it's going to continue to be gold, not silver, that outperforms. A lot of people are saying that the gold-silver ratio is out of whack. The silver is the thing to buy. Is that the case? Or is it more the case that because this is being driven by central banks, that we're going to do what the central banks are doing, which is buy gold? That's what's going to outperform.
To the latter question, I think you've made a great point. Silver speculators and gold stock investors have been concerned over the fact that while gold has performed, the other asset classes haven't. And you put your thumb on the cause of that. The buyer has been central banks, and they don't buy gold stocks, they don't buy silver, they buy gold. An asset class that had a buyer did well, an asset class that didn't have a buyer didn't do as well. Typical precious metals bull markets are led by the commodity, by gold. When the gold price increases faster than the cost to produce gold, the margins of the biggest and best mining companies begin to do well. And we've certainly seen that over the last 18 months with Agnico Eagle, well, with the whole complex. They've done extremely well. In traditional bull markets, the bull market goes from what I would call the best of the best to the rest. There begin to be valuation anomalies between the very high quality companies and lower quality companies. Either value arbitrageurs take that out of the market, or else the big companies take over the little companies. In my experience, Eric, when the generalist investor comes down into the precious metals space, when the narrative is established by gold and by the gold stocks, silver begins to outperform gold. I'm not sure why, to be honest with you. Perhaps it's because the lower unit price, perhaps because of the reputation for volatility. But in my experience, in the three precious metals bull markets that I've lived through, when the generalist investor comes into the space, silver begins to outperform gold. Now, as to the gold-silver ratio, I've never been a believer in it. I sort of believe it's a factoid. The fact that silver is 16 times more prevalent in the Earth's surface suggests that the gold-silver ratio should be 16 to 1. But that argument doesn't go to utility, and it doesn't go to the fact that most of the silver produced in the world is produced as a byproduct of mining other materials, which means that the production cost for 78% of the new mine supply deals only with the cost of extracting it from already mined and processed rock. So I think that there is a disconnect between the supposed importance of the gold-silver ratio and gold-silver markets. I'm not sure as to how one would model that as a trader. I'm not a trader, so I don't do it. But I will observe that the markets, the last three markets that I've been involved in, once the precious metals narrative has been established by gold and the generalist investor comes down into the space, that the generalist investor takes up the silver prices faster than the gold prices.
Rick, let's move on to gold equities. The old wisdom used to be, look, you buy the gold equities because it's leveraged to the gold price. Well, guess what? That has not worked for the last 5 years. My brokerage statement is proof of that. What broke down? Why did that stop working? And most importantly, how do we read it now? Because, one argument is, okay, that doesn't work anymore, so buying gold equities is dumb. The other argument would be gold equities have underperformed for a long time. They've got a lot of catching up to do. They're really, really ripe for a big move. Which is it?
I think the truth is somewhere in the middle. I remember very well the gold bull market between 2000 and 2010. In that market, the gold price did extremely well, almost up sevenfold. And the free cash flow per share among the gold producers fell. It took particular skill for the industry to take a sevenfold increase in the selling price of their commodity and turn it into reduced free cash flow per share. So the expectation around the gold producers was very low this time. The second thing was that the buyer that came into this market that moved the gold price up, as you suggest, was central banks. And central banks don't buy gold shares. Now, this bull market has followed a predictable pattern. It has been led by the commodity. In the beginning, in 2023 in particular, not only was the absence of a buyer, which is to say the central bank, an important tenet, but also the cost of producing gold increased as fast as the gold price. So the increasing gold prices didn't expand producer margins. That turned around in 2024. And the producers that generated good margins, particularly the companies that generated good margins that were large enough to attract some institutional capital, have done very well. Ones like Franco-Nevada, ones like Wheaton, ones like Agnico Eagle, the very high-quality companies, are uniformly doubled over the last 18 months. So the market has noticed. But there's no broad participation in the gold market yet. I believe that the momentum established by the senior golds and the free cash flow that's now being generated by the tier 2 producers and the less efficient majors, as was evidenced as an example by the Newmont release earlier this week, these are truly spectacular cash flow numbers. And I think we're really, truly in now a gold equities bull market. I believe that the market will come to understand that the management teams that were responsible for the capital misallocation in the market 2000 to 2010 have been thanked and excused. And at least for the time being, perhaps until the bull market gets underway in earnest, that there will be intelligent capital application in the gold mining industry. I think the next 2 years, 2.5 years, will be extremely good for the gold stocks. If the valuation discrepancies that exist between the very large index-worthy companies that get a lot of passive buying and the rest of the gold market doesn't disappear, that is, if value arbitrageurs don't begin to redeploy from the best of the best to the rest, then what will happen is that the large companies with very low cost of capital will take over the smaller companies, and the arbitrage will go away in that fashion. At any rate, I suspect now that we are really, truly in a gold and gold equities bull market.
Well, Rick, I can't thank you enough for another terrific interview. We got to get you back on the show more often than it's been. But before I let you go, I want to talk a little bit more about what you're doing with your new company. Well, I say it's a new company. It's been probably a couple of years now, which is Rule Investment Media. A lot of people used to know you as the guy who organized most of the private placements in the gold and silver mining industry. You sold that business to Sprott. You ended up retiring from that and launching this new venture. Tell us about it. What does it do, and what's going on?
Eric, I was part of building two very large consumer franchises. Sprott, which was 275,000 retail precious metals investors and institutional investors, and of course, Everbank, another 275,000 savers. I'm less eager at age 72 to be in regulated businesses. When directors' meetings at Sprott became more than 50% involved with policy and procedure and DEI, stuff like that, that's all important. But I didn't have much to contribute, so I had to go away. But I wanted to stay in touch with my market. I wanted to stay in touch with my customers. And so I set about building a business to educate investment professionals and high net worth retail investors about how to invest in natural resources and precious metals. People like Wiley have been after me to write a book for about 30 years, and I don't want to write a book. So the Rule Classroom and Rule Investment Media is the way that I impart the lessons I've learned over 50 years to people who are just coming into precious metals and natural resources. Most of the services of Rule Investment Media and the Rule Classroom are free, a very, very good price. 4 times a year, we put on boot camps, which are deep dives into various topics. We've done uranium, we've done silver, we've done the capital stack of mining companies, we've done oil and gas. And once a year, we put on a great big symposium. We just got done doing that this year in Boca Raton. Delighted to say between live and live stream, we had 2,400 attendees, I think. Wonderful conference. And so that's what's really keeping me involved. Your listeners who like what I have to say about natural resources can personalize it. If they go to my website, ruleinvestmentmedia.com, and they list the natural resource stocks that they own in their portfolio, I will, for free, rank them 1 to 10, 1 being best, 10 being worst. And I'll comment on individual issues if I think my comments might have value. This is free. There's no obligation. You need to be patient. I'm about 250 rankings behind. But once again, ruleinvestmentmedia.com, list your natural resource stocks. Please, no crypto, no tech stocks, no pot stocks. Leave an old man to do what he does best.
Again, that's ruleinvestmentmedia.com. Patrick Ceresna and I will be back as MacroVoices continues right here at macrovoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Rick back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Rick's picture saying looking for the downloads.
Patrick, let's kick this off with the S&P 500. What's the driver for the whipsaw that we saw in the S&P chart on Wednesday? And is this market finally starting to roll over?
Well, Eric, last week we talked about that this is the pig in the python moment for corporate earnings, as we have 4 of the Mag 7s literally reporting within 24 hours of each other. and they didn't disappoint in terms of an impact on the market. Well, at least now at the time of recording, we've gotten Microsoft and Meta's earnings, which were decisive beats, and having each of them gap beyond one standard deviation of what was priced into the options market. This has clearly spurred the S&P 500 to have a gap higher and attempting once again to make a higher high. This rally has been relentless. We have now been 100 days above a 20-period moving average, which is rare. It doesn't happen very often that we have that kind of a sustained move without a correction coming. At some juncture, there will be a correction, but there is zero evidence that one has begun. Right now, there are measured moves that target this 6,500 and 6,600 level up above. There's no reason at this moment, unless there's a huge miss by Amazon and Apple, for this to not finish a short-term move on the upside. That doesn't change the fact that the asymmetry is quite skewed against the bulls. Point is that the trend is your friend. It's been working, and certainly those that are invested continue to be rewarded for pressing this trade. The point I want to speak to here is that the bulls that have been invested in this market are being very well rewarded for continuing to press the longs. But deploying brand new money up here does have bad asymmetry. At some stage, we are going to get heavy and toppy in this market. That doesn't necessarily mean that some big bearish breakdown has to occur. The most common thing to happen off of a bull run like this is a typical 5% correction. At this stage, that would result in about a 300 S&P point pullback. Many of these types of pullbacks last about a week or two and then resume back to retest the highs. So even though a correction is overdue, more often than not, it's not a shortable opportunity unless you're a day trader. And at this stage, it really comes down to there's not much reason to panic out of long positions, but it's certainly a bad trade to keep doubling down and adding to positions up along these highs without a correction to buy the dip on. Overall, there will inevitably be a topping formation and at some stage a much deeper and more pronounced market correction. But often topping formations can take months, and the fact that we haven't even begun one means that odds are that throughout the summer the market is going to be contained to these upper levels, and that more ominous stuff is really going to be more likely a fourth quarter story at this stage. Obviously, are going to be looking at things like the Fed rate cut out in September and other types of trigger points. But right now, the only thing I think that could short-term take the wind out of the sails of this market would be a huge jobs numbers miss. But that we'll find out on Friday. All right, Eric, let's move on to the U.S. dollar. What are your thoughts?
Well, Patrick, overall, I'm still structurally bearish the U.S. dollar. But as I've been saying, we need to watch for a counter-trend rally, which frankly is overdue at this point, and we're starting to see signs that it's finally arrived. So this could have legs, but just consider the context here. We're getting excited that we're up to high numbers on the Dixie of 99 point something. It's still less than 100, and we're thinking of it as a high number now. So this could have legs. We could get back into the low hundreds. I think probably staying below 104. How much upside is there? I really don't have a target, but I am convinced it's a counter-trend rally. The major trend is still down. The final low for the Dixie is not in yet.
Well, Eric, I've been pretty consistent with my members about the fact that this is a very crowded trade, and that often the pain trade is for there to be a short squeeze to shake out all of those high conviction traders. At this stage, the fact that the dollar didn't make a lower low on that last dip, and now we have the first close above the 50-day moving average in 150 days. The fact that we now have seen a higher low and a higher high, and such a rapid rise in the dollar, it is something that needs to be watched, because short squeezes tend to be fast and violent. There would be nothing gradual if this did materialize into that. What makes my conviction that we're in the middle of a short squeeze that much stronger is that when you go to the individual pairings of the different currency crosses, you can see a distinct breakdown in the euro, topping formation in the pound, a sequence of consolidation and a break to higher highs in the yen, the Canadian dollar breaking out of a sideways multi-month trade range after a very strong drop in the US dollar against the CAD. All these different cross currencies are all setting up for a US dollar rise. And so the idea here that the dollar index can shock everyone with a move up to 102 to 103 on the upside in a very rapid fashion is something that is really on the table. Now, the one thing I want to highlight is there doesn't have to be a fundamental reason behind a short squeeze. It is a flows thing. It's a situation where the trade was crowded and simply over leveraged. And the thing that I want to watch here is that if we did get one of these short squeezes and the fundamentals didn't pivot, that might actually be another opportunity to go short the dollar once one of these squeezes gets underway. So this to me is a tactical trade for the upside of the dollar and not a big fundamental one. All right, Eric, let's move on to crude oil.
My time spread trade continues to perform extremely well despite the weak flat price. I don't have any directional trade on, but boy, I do have big respect for Rick, so I'm going to think seriously about the comments that he made in favor of a longer-term, long directional position. That certainly is favored or gets a tailwind from the structural backwardation in the market, which seems persistent and has been persistent even in the face of the price dips that we've seen. So I'll keep thinking about that one and maybe give you an update next week. But for now, it's just a time spread trade that I have on.
So, Eric, on page 4, I have the crude oil chart, and I highlighted in a box the 7-month trade range crude oil spent from September 2024 to March of this year in a sideways trade range that defined the bottom end range in the $66, $67 area and the upper range up towards $80 a barrel. Now, the breakdown that we saw in April came at the same time as there was huge turmoil in the markets, uncertainty about tariffs, and more importantly, real genuine risk of recession and a downturn in the economy. That has all subsided and everything is normalized. In my mind, crude oil doesn't belong down in the mid-50s. And so when we consolidated here in the $65, $66 range, it is likely in my mind that this is going to be the bottom end of the trade range as the crude oil market goes back and starts trading in the trade range that it was in the prior 7 months to that breakdown. And so I think we have a situation where crude oil can trade even back up towards $80 on the upper boundary and then bounce around in this trade range for the rest of the year. Generally, I think that there's room for crude oil to be in some form of a short-term bull trend as it approaches those upper ranges. All right, Eric, let's move on to gold and really size up the way that the volatility has been trading in the last week.
Patrick, 3,300 is the must-hold level for this symmetrical triangle pattern, and it didn't hold as of Wednesday's close. Now, it's always possible, you can sometimes have a bad close. It turns out that it was a fake break. It recovers overnight. Turns out it was a false breakdown, and it's all better by morning. If that's going to happen, it has to happen pretty darned quickly here because it looks like we're seeing the beginning of a breakdown below 3,300. That could very well beget more selling and accelerate the downside. Next obvious stop would be 31.27, and then 3,000 would be the next downside target below that. I think all indications we're seeing are that unless there is a stick save that gets us back above 3,300 so that we can stay there above 3,300, if that doesn't happen in the next day or so, I think 3,000 is probably in play as a downside risk scenario for a deeper correction. So let's see where this goes. I think the dollar rally is driving a lot of it. So how far we can go up on the dollar probably determines how far we can go down on gold, but a deeper correction looks like it's in the cards. We'll see what happens.
It is very interesting, Eric, to watch gold pair pivoting. All year, we've been above the 50-day moving average, and higher low sequences have been persistently going. We've now been in this horizontal triangle pattern, which I drew out on the chart on page 5, and we went and tested the upper range. We were entertaining the idea that that could have led to a bull breakout like we've seen in many of the past triangle patterns, but gold directly tested that upper trend line and directly failed and traded right back down to the June low. The catch here is that this is now the first sustained period below the 50-day moving average since the start of the year. Now, the other part that has to be considered is that the US dollar is breaking out. So we're seeing almost all cross currencies against that US dollar declining. And if you observe that gold has often traded like that cross currency to the US dollar, then if the US dollar is in some sort of a short squeeze and rise, maybe that becomes the backdrop from which gold is going to do a bigger or deeper correction. Now, the Fibonacci retracement of the entire year rally is back down to 3,000. Now, that to me isn't a new bear market. That wouldn't be something that would be devastating, but maybe, just maybe, we could see still a several hundred points to the downside of gold for the next buying opportunity. Overall, to keep this very simple, if the US dollar continues to rise and we see gold remain below this 50-day moving average, we have to accept that some sort of a correction of the rally from the first 7 months of the year may be underway, and then we'd have to evaluate where and how low it will go before we see the next bull trend resume. All right, Eric, let's move on to uranium.
Patrick, this is playing out very much as I expected. We are getting the consolidation pullback that everybody expected. It's just that it's only about 2 or 3%. And to my eye, trying to trade in and out to catch the smaller moves in a market like this is crazy. I don't want to risk losing my position. Now, there is one reason to expect a deeper correction here that's very reliable, even more reliable than technical and fundamental analysis combined. That reason, Eric just abandoned my previous plan to scale in systematically through August 15. I said, screw it. I don't want to miss this market. And I just went ahead and put on my full max risk long position in both uranium mining shares and call spreads on the URA ETF. So I put the last of my long position on the dip on Monday. Of course, the market loves to embarrass as many people as possible. So after I went all in, put on my max risk position, and then said so on the air, the market is probably going to humiliate me with a deeper correction between now and Labor Day. But that's fine with me. My bullish conviction couldn't be stronger in the intermediate to long term. If we take a bigger dip here and I lose a few bucks, I'll make it all back as this comes back. I really think it would take a bigger than Fukushima-sized nuclear plant accident to derail this nuclear renaissance at this point, and the market hasn't even begun to price in what's coming. So I couldn't be more bullish, but there's definitely a risk period between now and Labor Day that we could see some consolidation and pullback, and as I said, I've just jinxed it by telling you that I jumped the gun and put my full position on. So we'll see what happens.
Well, the equities have been rock and rolling, and that trend continues. But I like to focus here on looking at that physical uranium trust. And what we've had is a consolidation after a really nice bull breakout. Now, overall, we've been in a one-year bear market since the start of 2024, and it's really showing all the signs that that bear market is over. Now, with this dip in uranium prices, if this overall holds a line around these support lines and begins to bull higher from here, that would be a tactical new buying opportunity, looking for a further advance back towards even September's highs from last year. We can't talk futures without pulling up this copper chart. Let's talk about what happened here.
Well, Patrick, I've said this before, but I can't say it strongly enough. The lesson that traders should take to heart from Wednesday's record slaughter in the copper market is that President Trump and Secretary Bessent are not concerned about the collateral damage that their policy initiatives are going to cause in financial markets. So that means we should expect more crazy vol events like Wednesday's crash in copper prices on the back of whatever the next Trump policy initiative turns out to be. Is that going to be market positive, market negative? Well, the only thing that we know for sure is all indications are that they're not going to give us any forward guidance or warning, and we're going to get shock events in reaction to these new policies. It was dirt simple to see this coming. I told you here on MacroVoices that the stage was set for a full downside retracement of all that upside that we saw in reaction to the tariff announcement. But I also told you that I was not going to take that trade, and the reason was there was just too much policy initiative uncertainty. We don't know what they're going to do next, and it's very clear that they're not going to tell us. So the story that really is different this time, I think, the knee-jerk on this one was down. It sets us up this time. What I said before is when it was a knee-jerk up, I didn't want to try to trade out of that, even though I thought a knee-jerk down was probably coming, because I didn't want to lose my position. Well, now you just got the buy the dip opportunity, if you didn't have a position on already, to buy copper for the longer term buy and hold. I think this is a fantastic buyable dip here. I will probably be adding to my position, although it's already overweight and I just got clobbered on this thing Wednesday. I'll probably be adding here just because I think it's an incredible opportunity. So this one is a better opportunity. Other than that, though, nothing's different. We're going to see more knee jerks, not just in copper, but in other markets in reaction to Trump policy announcements, both tariffs and on other things. Brace yourself, put your seatbelt on. I don't know what's coming next, but there's got to be something.
Yeah, Eric, it was very dangerous because the COMEX copper was really diverging from the LME copper out in London, and that's largely because it was almost all driven by tariff risks. What is clear is that Trump is going to be persistently pivoting on all sorts of these headlines, and clearly this is causing some serious volatility here in copper prices. Overall, I don't see this being a material impact on copper equities, but certainly those that are trading the futures markets are experiencing maximum volatility here.
Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
All right, let's talk interest rates. We have year-to-date a trade range that's been established between 4% to 4.80. And so we now have a situation where we're virtually trading in the dead center of that trade range in one huge horizontal triangle. The interest rate market has not made its move. You can see as well on the 30-year yield, it also continues to consolidate in a 3-month trade range, but much closer to the upper boundary of the 5% yield. What we can see here is that the interest rates have not yet been the wrench that's thrown into the gears of the equity markets. Well, it'll be very interesting to see if we start seeing stress points on the yield markets as we move forward. But as of this moment anyway, we're not seeing the long end moving yet. But what is interesting, I want to highlight here, is that after the FOMC, the probabilities of rate cuts have pivoted. We've gone to now where the September rate cut, which was the highest probability, has now actually pivoted to where it's only about a 43% odds of a rate cut in September and a 56% probability that they leave rates unchanged. And as well, when we go and look at the probabilities of where interest rates will be going out to the end of the year, out on December 10th, one can observe that now the highest probability of over 40% is being priced in at only one rate cut this year and about a 36% probability that there will be 2 rate cuts. So slowly the market is rebalancing the probability that the Fed moves. What's interesting here on page 12 is I am showing this chart that's showing the rate cut expectations of 2025 versus 2026. And what we can see is that while there is dovish descent in there, that 2026 actually actually upticked the probability of further lower interest rates, while 2025 had the decline. So what this means essentially is that the market is pricing less likelihood that the Fed is going to move this year, but actually an uptick in the fact that they're probably going to be more aggressive in 2026.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the chart book we just discussed here in the Postgame, including a link to a number of articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X @MacroVoices for all the most recent updates and releases. You can also follow Eric on X @Eric S. Townsend. That's Eric spelt with a K. You can also follow me @Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.